Welcome, DreamsFX Mastermind students. This is the beginning of a lifetime education experience for all of you, and this is going to be the first video that we're introducing on the back end of the website through the student portal exclusively for your own disposal, for you to master individually all of the concepts, so then when you're faced with the whole, you know exactly what to do and really becoming a true mastermind, understanding the management, the strategy, every individual component, and understanding how they all work together and making it a functioning gear, or aka the whole roadmap and how we're gonna get to the destination, understanding all the inputs to get the desired output, understanding what the central bank algorithm is, a series of inputs to get a desired output. With that being said, now we're going to be exploring order blocks, understanding what they are, in very fine detail, what's the reason that they happen, how and what the purpose of, really imbalances are, as I know that, especially in identifying order blocks, you need to understand and master imbalances. So that's gonna be the first thing we cover here, going right into order blocks, the criteria, the 4 key features of what's needed, and then a few examples thereafter. So enjoy the video, take some good notes, and welcome to the lifetime education journey. Let's go ahead and dive right into it. Order blocks 101, understanding the purpose, the anatomy, the reason, and the intention of order blocks. So first things first is, well, what is an order block? An order block is essentially one specific candle that represents a zone that illustrates supply and demand, where the banks are essentially getting in, manipulating price before causing a drastic move in the opposite direction. So what happens is when you see a very large move happen anywhere, right? When you see a very impulsive move happen, whether to be, an impulse from a higher low to make a higher high. Well, we always look for order blocks at relevant areas. So we're going to be generally looking towards that higher low that made that higher high. We're going to look for some form of candle that took out some form of trader that the institutions and banks manipulated to collect their profits in order to go the opposite direction. And at some point in the future, we're going to be generally expecting a price to come back to return to that order block, which we call the process of mitigation, mitigate that order block in order to then go higher and continue new higher high structure, new bullish structure. Likewise for sells, right? If we are in a downtrend and we are looking for sells, we're generally going to be paying attention in the area of that lower high range that made a lower low. We're going to be looking for an order block there that took out some form of buyers manipulating the market in that direction and then causing a drastic move to the downside. So that is where we're going to be specifically looking towards, looking for those entries. And again, these are relevant areas of supply demand. So if you hear sponsored candles, supply demand, points of interest, they're all based upon order blocks, just different fancy lingo that illustrates whoever has their own interpretation or their own naming for it, but it means all the same thing essentially. But in order for us to go any further, understanding, specifically where they occur, right? Because we know the general area, we need to first dive into the anatomy of understanding the first and most important thing that helps us understand what order blocks is, and those are imbalances. So the first question is, what is an imbalance? Well, an imbalance is an area in the marketplace that illustrates only one type of collective order that is taking place. So meaning, if we're in a bearish market, right? You're going to see several bearish candles in a row with no bullish candle. And oftentimes what is left behind is a gap. And a gap is illustrating inefficient market price action. And what this gap is further telling us is that during that period of time, there's only sellers in the market. Well, what needs to happen is the market always needs to be equally distributed, and these gaps will always be filled. So let's go ahead and see, furthermore, what an imbalance is. So when we're looking at this chart right here, essentially an imbalance is a 3-candle pattern formation that leaves some form of gap behind. So what we have illustrated here is we have our 1, 2, and 3 labels. And what we're really paying attention to here are the 3 candles that actually form the imbalance. So the first candle is right here. And oftentimes what you're going to realize is this first candle, what's going to happen is immediately thereafter, we're going to get some form of engulfing candle on candle 2. Candle 1 high in a bullish market will leave some form of gap as the next candle engulfs candle 1. So when I mean engulfs, it doesn't necessarily have to look like that picture perfect pattern where everyone's like, oh, well, we have one candle here, and then the next candle immediately looks like this, right? That is engulfing, but we need to understand more specifically what the anatomy of an engulfing candle is. What we're trying to say is, if we have our candle 1 high, wick high here, candle 2 opens below the candle 1 high, and it closes above. And what happens thereafter is candle 3 just wicks down somewhere into candle 2 and then goes higher without fully coming back to this wick of candle 1. And this is what's representing an imbalance. An imbalance is the gap in a bullish market, mind you, for when we're looking for buys. It's an area of inefficient price action where we've 1, 2, 3 bullish candles, and if you look immediately to the right, there's a gap. Whenever you identify imbalances, you look at current 3 candlestick formation, you look immediately to the right, and if you see that this candle low, wick low of candle 3 has not fully closed on candle 1, that represents an imbalance. And what do I mean by fully closed? Well, the candle needs to look, rather than, again, like how it currently looks, it needs to look like this. It needs to fully close and come back to candle 1. So if the candle, for instance, looked like this compared to the other where it was barely just coming in and kept going higher, this would no longer be an imbalance because wick low of 3, right, has now fully closed the wick high of candle 1. And if it fails to do this, then again, like just illustrated, this represents an imbalance. And at some point in the future, right, price can keep going higher and higher, but at some point in the future, for price to even go higher than that initial point, it must come back to this imbalance and fully close this wick high of candle 1. So in the future, we are going to expect price to come all the way back down here, right? Expect to come like down, fully close the candle of one, and then resume higher. So this is what a bullish imbalance is, and it's the first pivotal step in understanding what an order block is, because there are 4 core features that we're going to be explaining just here in a couple minutes. But again, understanding what imbalance are essential for us to be understanding how to identify order blocks, as they represent inefficient price action. So if I were to ask you all next, where do you see the next imbalance after this? Well, we clearly see it. It's between this wick high of this candle and this wick low of this candle. And if you see, this is another common thing that a lot of traders will oftentimes run into. They see something that looks like this. Price will just come back into the imbalance and then go higher. Well, notice if we are, again, you can start anywhere with this 1, 2, 3 candle formation. Let's say we had our candle 1 here. Oops, my bad. Let's say we had the candle 1, we had the candle 2, and we have the candle 3. Well, candle 2, right, if this is the open, it still opens below the wick high of candle 1, and it closes above. So this is still an engulfing candle, mind you. Opens below and closes above. Well, now what does candle 3 do? Does it come back to close this line right here? No. So this is indicative of another imbalance. But notice what the next candle does, right? It just comes slightly into the imbalance, and then it goes higher. This is a very important note because the imbalance is not fully closed. So now where does the imbalance lie? Well, it's not between here. It's between here. And this is still representing inefficient price action that at some point in the future, price must come back down to this imbalance. And you're going to see imbalances all over the chart everywhere. They're present on the higher time frames, lower time frames. And again, we start very basic as, for some of those who might be struggling with imbalances or order blocks, this is the first video that you want to go ahead and reference before getting into the complexities and, the very advanced mastermind protocols, because you must understand what order blocks are prior to getting into anything revolving around the algorithm. So let's look at another example. All right, if we're looking here, we can see that same 3-pattern candle formation. Again, you can start anywhere. We have our candle 1, our candle 2, and our candle 3. And again, what do we look for on this candle 1? Well, the wick high of candle 1 in a bullish market, we see it's right here. This second candle engulfs the first candle. It opens below the wick high of candle 1, and it closes right above the wick high. So this is an engulfing candle. Great. But what does the third candle do? Does the third candle come down to completely test right here, the high of candle 1? No. The wick low of candle 3 just comes down a little bit to go higher. So there is an imbalance behind between the wick high of candle 1 and the wick low of candle 3. So at some point in the future, price must come back down to this imbalance before resuming higher. So you're going to see imbalance everywhere, right? But this video and this introduction portion is just to help you understand where imbalances are, not telling you, oh, this is where I enter. This is a point of interest. We're not getting into any of that yet, but just so you can fundamentally understand what imbalance is, this is what they appear as in a bullish market, right? So now let's say rather that we had something that looks like this. Let's say this wick low of candle 3, 1, 2, 3, did this. Let's say it did this. Well, notice if we have a 1, 2, 3, now is there a gap between the wick high of candle 1 and the wick low of candle 3? No, because now this is telling us that we now have equal distribution. There's no inefficient price action. The market is equally distributed because there is no gap. So what we do is we simply don't look for anything over here. There's no imbalance, and we look for price to just continue, right? But of course, that's not what happens. So of course, we do have an imbalance behind. And mind you, you're going to see imbalances everywhere. 1, 2, 3. The wick high of candle 1, the wick low of candle 3. Yet again, we see another imbalance between here. So at some point in the future, price is going to have to come back to this wick high of candle 1 to close that gap, right? So this is the examples of bullish imbalances. Now what we want to go ahead and do is let's go ahead and direct our attention to what a bearish imbalance is. A bearish imbalance on the opposite end is the same thing, just in the opposite direction, right? So let's look over here. If we're talking about 3-pattern candle formation, we have candle 1, we have candle 2, and then we have candle 3 right here. On the contrary, compared to in a bullish market, we are directing our attention to the wick low of candle 1. The wick low of candle 1, right? What happens? Well, the second candle opens above the wick low and closes below. So this tells us that the second candle is an engulfing candle. The third candle now, what happens? Well, the wick high of candle 3 just came up a little bit, and then price kept selling off. So this is representing now a gap, right? We have a gap between the wick low of candle 1 and the wick high of candle 3. So at some point in the future, what price needs to do is it needs to come back to the wick low of candle 1 over here before even deciding to continue lower. So oftentimes what price is going to do, as just previously mentioned, is it'll just keep going down, 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 down. But before it makes the lowest move in the future, it must come back to completely fill the wick low of candle 1. Now, let's say it does something like this. Let's say that price just comes up into the imbalance right here and then drops. My question to you is this considered a fill of an imbalance or a gap? No, because the whole imbalance is still right here. But what happens is you see the imbalance now in size has been reduced, right? Because we still have a gap. It's not between these 3 candles or these 2 candles. It's actually now between here. So we still have a gap, but at the end of the day, price must still come back up to fill candle 1, so it is equally distributed, right? It must come all the way back up to here. It doesn't matter if it just touches it, it goes a little bit past it. It doesn't matter, right? It just must come back as there is an imbalance there. It needs to be completely closed. If it's not completely closed, there's still an imbalance. So let's look right here. Again, you can start anywhere. Let's just say candle 1, candle 2, candle 3. Well, if this is candle 1 right here, we have candle 1 right here. The wick low of candle 1, candle 2, what does it do? It engulfs candle 1, it opens above the wick low, and it closes, right, closes here below the wick low of candle 1. That's the first criteria. But the next thing is, what does candle 3 have to do, right? If we're looking at candle 3, candle 1. Candle 3, in order to create an imbalance, it must just have a little reaction and it keeps selling off, creating a gap. Well, if we're looking over here, candle 1, candle 2, candle 3, what does the wick high of candle 3 do? Well, it comes all the way back to close this gap of candle 1. So there's no imbalance, which tells us that the market is equally distributed. We have efficient price action, and price will just keep going lower. So this becomes the only imbalance that price must return to completely close in the future before continuing selling off. Let's look at another example. All right, let's see here. We see another imbalance formation. We have our candle 1 here, right? We have our wick low of candle 1. We then have candle 2, which does what? The wick low of candle 1. Candle 2 opens above the wick low of candle 1, and it closes below the wick 1 low. Great. First criteria. What's the second and most important thing? Wick high of candle 3 must leave some form of imbalance or gap between the wick low of candle 1 and the wick high of candle 3. Now, when this happens, notice what price does. It just keeps going lower. So at some point in the future, prior to continuing to sell off, it must come back to completely fill wick 1 gap. It must come all the way up to close it. And that tells us there's no imbalance, and then price can keep selling off. So imbalance is the first and most important thing that we need to understand prior to understanding order blocks. Now, as you can possibly imagine, well, we're not entering based off imbalance. We don't even identify imbalances on our chart because we are going to get to the point to where we see them everywhere all the time. This is, again, very basic, very introductory. But as you're now going to see, imbalances are the first essential thing to identifying order blocks. And you will see them all over the place. But just so you can start getting into practice and a habitual routine, just practice identifying imbalances as they're going to tell us, aka where the order blocks are, which are candle 1. Candle 1. This is where price must come back to in the future. So now what we're going to do is now let's go ahead and go back to our first page, Understanding Order Blocks 101. So now we fundamentally, or rather conceptually, understand what an order block is, right? It's a single candle of supply or demand where the institutions or central banks come into the market, take out some form of trader, and cause a relevant and meaningful move to either continue lower or go higher. So why do they form? Again, areas where institutions are entering the marketplace to stop out some form of trader before reversing the opposite direction. And we utilize them for entry because during this period of time, the institutions are taking out some form of trader. So when we're looking at a diagram perspective, let's say we're in a bearish market, right? Let's say we're selling down. Well, what's going to happen is before price continues lower, some form of orders, right? Some form of buy orders will be collected. And the institutions, what they're doing is they're funding with their own capital. Again, IFC or institutionally funded candle is what we specifically call order blocks. Just another synonym, they're the exact same thing. So what happens is the institutions are actually buying in this area to take out those who are trying to sell and buy above. So when this happens, they're taking out all of these traders who have their stop losses above these highs. And then what happens is price will then just absolutely reverse, or rather melt and sell down to the bear side. So what's happening is during this period of time, institutions, they only enter the buys, right? To take out all these traders to collect their stop losses, which they make money off of, right? They make money off of our stops. And then price is just going to reverse. Well, during this whole period of time, this is what's going to happen. When we see an order block take place to take out the liquidity and price runs away, the institutions, they didn't cause the sell move to happen. The only move that they got in and capitalized on was the bullish move. So what's happening is during this whole period of time, institutions enter their buy orders to take out all of these sellers and buyers before reversing price. During this whole period of time, they don't have stop losses. They're in drawdown. So what must happen is the institutions need to come back, right, to break even on their position. And what's going to happen is the institutions, right, will rinse repeat the same process. There's going to be either some form of sellers here, right? Then they're going to get immediately liquidated. And the institutions are causing this move to come to mitigate out of their drawdown because, again, if they entered buys here, the whole purpose was just to collect money in order for price to continue lower. They're in drawdown this whole time, so now they need to rinse and repeat the process. In order for them to break even on their position over here, their buy position, they're going to do the same thing. They're going to accumulate some form of retail orders. They're again going to liquidate their stop loss, collect the money, and also in doing so, they're going to be breaking even on their position in order to, right, go lower. So then this is what we call the process of mitigation or order flow, where the institutions are routinely stopping out traders, reversing price in the opposite direction, and they'll need to come back to break even on their position, right? They'll come back to break even on their position, but before continuing to break even, they are simultaneously going to be collecting the stop losses of those traders who are selling just before or who are looking to buy up into it, right? And then price will continue melting lower. So then following order flow, we are going to imagine that money has now been effectively transferred from this order block to where? Now this one over here. And now what the institutions are going to do on a conceptual level is at some point in the future, they're going to rinse and repeat the exact same thing, building some form of accumulation to take out those traders to break even on their buy position and then reverse price lower. But this is just, again, conceptually, this is happening everywhere, every time frame. But before we get into the nuances, intricacies, and complexities, we need to understand fundamentally what order blocks are. So now that we understand conceptually what they are and where they occur, right? Because they occur at areas that have relevance. We see that this whole momentous move was caused from this area right here. So it makes sense for an order block to lie here. Likewise over here, we have a lower high, a lower low, a lower high, and now we have what? A lower low. This becomes a relevant area that we're going to want to be looking for an order block before price continues lower, right? So order blocks happen in relevant areas, but as we know, there's only two specific areas at most we should ever be looking for order blocks with the expectation that they're going to be making new structure. and that's going to be in another video, so stay tuned for that. But let's go ahead and dive further into order block anatomy and the core 4 features. So now that we conceptually understand all of these answers, now we're going to wrap up today's video going over specifics of order blocks and show you more specific examples. All right, so we need to understand that there are 4 key features of order blocks. The first thing that all order blocks need to do is they need to take out some form of liquidity before reversing price. Meaning, if we see an order block that is going to the buy side, right? If we're in a bullish trend, we're going to be taking out some form of sellers. Institutions are going to be taking out some form of sellers before resuming higher. Likewise, if we are in a bearish trend, if we're in a bearish trend, institutions will take out some form of buyers before, right, reversing lower. So that's the first thing, and one of the most important things is we need to take out some form of liquidity before making that new expansive move. The second thing, one of the most important, is you must have an imbalance. IMB is imbalance after number 1, right? We must have an imbalance after we take out liquidity. And that's what's going to validate and verify the order block. And as we talked about with imbalances represent inefficient price action. And as you'll see here in just a minute, when there's inefficient price action and price must, right, with imbalances, if we have imbalance, if we have a candle formation that we see something that looks exactly like this, we have this, we have this, we have this. And let's say the wicks appear just as so. We have a wick low, we have a wick high, we have a wick low, we have a wick high. Now let's say we have another wick low and a wick high. Well, where is the imbalance? Well, the imbalance is between the wick high of candle 1 and the wick low, the wick high of candle 1 and the wick low of candle 3. So if we know that imbalances must be completely closed, what we need to understand is that, well, if imbalances need to be completely closed, the order block, where price is actually stopping, is not at the imbalance, but it's actually going to be at this wick high of candle 1. So when we're looking at that 1, 2, and our 3 candle pattern formation, the only reason we identify imbalances because where price will actually stop in the future prior to continuing higher in this scenario, well, it must close the imbalance. And what's left at the close of an imbalance? Well, ladies and gentlemen, this is the order block. This is going to be the order block. So our wick 1 is going to be, our candle 1 is going to be the whole order block. And that's what we're going to expect price to return to, again, prior to continuing higher. Now it can come just tap the wick, it can come deeper inside of it. Doesn't matter because this whole gap is going to be closed and accounted for. So that is the first and second thing that we must have is this imbalance. Now let's say we had something that looked like this. Let's say candle 3, like mentioned, let's say it completely closes candle 1. Well, now in this scenario, do we have a gap between the wick high of candle 1 and the wick low of candle 3? No, right? Because it's been fully closed, telling us that, hey, this is efficient price action. There's no imbalance. So now this is not an order block any longer because what's the second most important thing for the core 4 features of an order block? We must have an imbalance. So this no longer is an order block. All right. After we have that second criteria for the core 4 features, the next third thing that we must have, again, you can't just have 2 out of 4, 3 out of 4. You need to have all of 4 things to have an order block. The third thing then is you must have the order block, aka candle 1, must cause a break of structure, right? A directional shift or a momentum shift. So let's say that we are looking at something like this to the left. Let's say price is going down, lower high, lower low. And now let's say we have another lower high, lower low. When we see price break structure to the upside, we know from obviously the bootcamp and the recordings that this is a break of structure, right? Break of market structure. We're now no longer looking to sell because this last lower high that made a lower low is now broken by a new higher high. So because we had a break of structure, this becomes a very relevant and intentful area for us to now be identifying an order block. So after taking out some form of liquidity, and my apologies, but the liquidity that we're talking about is it can either take out a structural point, it could take out a structural point like this before reversing price, or if it doesn't do that, it can do something like this, right? Maybe it'll just do this, right? The liquidity sweep can just be taking out the previous candle low. So if we had a previous candle low, it could look like this. Here's the order block, our 1, 2, 3 formation, right? 1, 2, 3 formation. This wick low takes out the previous wick low, liquidating this low before going higher. That's also a liquidity sweep, right? So just in reference to point 1, liquidity sweep means either taking out some form of structural point before reversing, or it'll just take out a single candle wick low before going higher in a bullish scenario. So after we have this momentous push, the last and one of the most important things as we're going to get into as the videos are continuing to be released throughout the order block section is we must see liquidity form before the order block. So yes, we have the imbalance. Yes, we have the liquidity sweep. We have our 1, we have our 2, right? The imbalance. We have our 2 now. Our 3 is going to be the break of structure momentum shift. Now the fourth thing is we need to see some form of liquidity. And why do we need to see liquidity? Well, liquidity is what's going to tell us the whole narrative, right? Because as we just talked about previously, and you can rewind if you missed it, but liquidity building before an order block is telling us that some form of orders are being accumulated here, right? Buy orders are being accumulated here. And what needs to happen? Well, the institutions, right, are going to manipulate price. Stop losses of those who are buying here are going to be right below here. Retail traders, they put their stop losses, if you're buying, just below lows. So how do institutions manipulate that to put money in their pockets? Well, what they're going to do is they're going to cause, using their own money, their own capital, they're going to cause price to sell off all the way down to come back to test this order block. So now what happens is this order block that we were previously entering on, right? This was the order block. We now are going to be looking to take an entry on it. And the liquidity is necessary because it's telling us that some form of orders are going to be liquidated. The institutions are going to be causing the sell-off to happen, which is going to effectively be having us buy and enter our position. After we go ahead and enter our buy position, what's going to happen? The same thing that we just had over here. We're going to have that same 1, 2, 3 candle formation. We'll have this candle 1. The next candle will look something like this. Then we'll have this. So now what's going to happen in the future is if we have the same thing, we have this wick low, taking out some form of liquidity, right? Mitigating a previous order block. Now we're going to have this. Same candle formation, right? We're going to have our candle 1, 2, 3. Between the wick high of candle 1 and the wick low of candle 3, is there an imbalance? Yes, right? So now where it becomes the new order block. The new order block is just going to become candle 1 because what's actually going to be starting this imbalance and what price must come back to is the absolute close of the imbalance. So for that reason, again, this now is going to become the order block, right? Takes out liquidity. It's causing some form of momentous push to the highs, taking out some form of structure to continue higher. So now what are we going to expect again? 1, take out liquidity. 2, right? Imbalance is made. 3, we have a break of structure or a momentum shift. The 4th thing now that we want to, again, rinse and repeat and see that same process is we want to see price build some form of liquidity before, come to liquidate these traders who are entering early, they're taking their buy positions early, stop losses are going to get rated by the institution, by the banks, before continuing higher. And that'll become the next order block. So this is that process that we call mitigation or institutional order flow. And these are the highest probability setups that we see that we'll be talking about later on in future videos. But for order blocks, it's the same routine cyclical process, and all order blocks must have these core 4 features. All right. Now, let's go ahead and finish off the video by going through just a couple examples. All right, so in this example, we can clearly see, and we're identifying structure. Just a disclaimer, we don't identify structure. This is very SMC based and very retail based. We trade based off of liquidity derivatives. We don't trade structure, but this is to help you gain a little bit better of an idea of how to identify order blocks. So we can see that somewhere we have bearish downtrend to the left. This is the last lower low, lower high, and we now have a new lower low over here. Now what happens is after we see the bearish structure, we see a new change in structure, right? New change in character or new break of structure. We're now looking for a buy bias. So now let's go ahead and find the responsible order block that, 1, took out some form of liquidity, has imbalance, and created a momentous move. If we're directing our attention over here, where's the first imbalance we see? Well, there's no gap immediately to the right. This wick is immediately covered. So there's no imbalance, there's no order block. Let's look over here. We have our candle 1, candle 2 is engulfed, candle 3, there's no imbalance. Great, same thing over here, no gap. But now what do we see? We see this candle take out some form of liquidity. First thing, check, first box check. The second thing that we look for is this candle must create some form of imbalance. We have our 1, 2, 3 pattern candle formation. And what's happening between the wick high of candle 1 and the wick low of candle 3, we have a gap. This tells us there's inefficient price action, there's only buyers in the marketplace, so what needs to happen is this imbalance needs to be closed. And what's lying at the close of an imbalance or this 3 pattern candle formation is the order block. So just talking about imbalances, candle 1, candle 2, candle 3, really the first candle is our order block if there is an imbalance, which there is. So we know at some point in the future, price must come back to here before continuing and making higher high bullish structure. Second check mark, checked. We now have imbalance. What's the third thing again? We need to see a momentous push or break of structure. After this order block occurs, after the imbalance, does it create some form of momentous push or a break of structure? Yes, it does both of them. So, boom, check mark. Now the last thing that we need to do is the order block is already valid, but to give us further confidence and confirmation this order block will work, we then just need to simply find or identify liquidity before the order block. And as mentioned, we identify liquidity because that's telling us there's some form of early traders that are entering the market. And what's happening is institutions are going to fund this move to stop out and liquidate, collect the money of these traders. And what's happening is when the institutions are liquidating these early buyer positions, they're collecting their money, putting it in their own pocket. But what's actually going to be stopping price is going to be an order block. So what's happening is we're getting several types of liquidity being collected, right? But what's now actually going to stop price after the final liquidation occurs is going to be the order block. So now what happens is we have multiple forms of liquidity, whether it be trendline liquidity, right, from the boot camp, whether it be channel, equal highs, equal lows, inducements that we're not going to be talking about right now. We see several types of liquidity being built, purged, collected. So now what happens is the institutions will collect the liquidity over here, right? Take out these buyers into the order block. And why we utilize order blocks for entries is because this is the area where institutions must come back to break even on their position, right? Because the liquidation that we identify, the first thing tells us that some type of trader was collectively stopped out before reversing price. And this whole sell-off that happened before price continued higher was the whole institutionally funded move that the institutions caused. And they're still in drawdown, right? It was a necessary evil for them to be in drawdown this whole time to collect the millions and billions of dollars funded over here. So now they need to break even on their position, which they do, and that's why we identify order blocks, because when institutions are rating stop losses to break even on their position, we're the only type of trader that is going to be successful only if we can identify the proper order blocks. And then what happens, of course, afterwards, we're going to expect price to rapidly just continue higher, higher, and higher. Awesome. So now let's go ahead and look at a couple more buy examples, and then let's go ahead and shift to a sell example. Pardon, we're going to go ahead and go through the sell example. So now we're looking at the sell example. We're going to approach it the exact same way. Let's look to the left. where is the first imbalance we see? Well, we know that we're directionally selling down, so we want to look for an order block for price to continue to sell lower in the future. So when we're looking all the way over here, do we see any gap? There's no gap. Oops, no gap. Oh, but here we have candle 1, candle 2, candle 3. Again, these numbers are irrespective to the imbalance patterns. This is illustrating the core 4 features of the order block. If you have candle 1, candle 2, candle 3, is there a gap between the wick low of candle 1 and the wick high of candle 3? Yes. So this is telling us there's inefficient price action. That price must come all the way back to fill right here. And again, we don't enter off of order blocks. The only reason we identify, or my bad, we don't enter off of imbalances. We enter off of order blocks. The only reason we identify imbalances is because it tells us that this candle right here that started this imbalance must be completely closed in the future. So we draw a box to represent that this is the order block because it does what two things first? First of all, does this candle take out some form of wick high or structural high to the immediate left? Yes. Even though it's ever so slight, this candle right here, we do have this candle high that raids or liquidates the previous high before causing a huge drastic move. That's the first criteria. The second criteria is now we have an imbalance between this wick and this wick over here, and we always look to the right. Great, second check mark, we have an imbalance. Now the last and third thing before considering identifying this as the order block is we need to see some form of drastic move or break of structure. Do we see a huge impulsive move to the downside without price returning? Yes. So it meets all of those 3 features, which is phenomenal. But what's one of the most important ones that's going to give us confidence that this is the correct order block? Well, we need to see some form of liquidity building in the future. Now, what we can clearly see right here is we have some form of equal highs that are lying here. This serves as a suffice area for us to be looking to liquidate in the future. But now let's even look further, right? Fourth thing, more liquidity. Notice what happens. We have some form of sellers, early sellers that come to the marketplace and cause the price to push down lower. Well, what's happening here is this is acting as a high or a collective area of resistance, right? We have several touches all over, right? So this is acting as a collective area of resistance. And what we know is this is a form of liquidity. So now that we can identify this area of liquidity, right? We have seller, all these sellers. We look to sell above highs into order blocks. This liquidity right here, AKA one of the inducement types, is telling us that these stops will get rated aggressively into, do what? 2 things. Fill the imbalance, make pricing efficient, which is going to consequently mitigate the order block which we're utilizing for entry or our higher time frame point of interest. And what do you know? This area that institutions using their own capital to rate price all the way up, we're collecting all these stop losses of all these early sellers into the order block. And now what do we expect price to do? Well, we expect price to then continue new structure, or better yet, attack lower levels of liquidity. As we know, we have all buyers who are looking at this as a support area, several touches. We know their stop losses are going to be below here. So this is how we collectively are able to implement order blocks into our approach, as it's always going to always ensure us that we have sniper entries, as this is areas where the institutions have previously gotten in the past to cause a directive move or momentous move to the upside, to the downside, and then they're just going to rinse and repeat the process over and over and over again. So by identifying liquidity before the order block, this is what's going to always tell us we're going to have a sniper entry, because again, institutions are rating all these stop losses into a previous area, right, where they stopped out of some type of trader that they need to break even on their position, and that's how we identify order blocks. Now, as far as the refinements, how low do I go? What time frame? How do I choose the best one? Those videos are coming up very soon, so stay tuned. And if they're already published, go ahead and watch those right after. But yes, this is how we always need to be approaching order blocks: identifying imbalance, the liquidity, being swept beforehand, imbalance, momentous move, break of structure, building liquidity beforehand, prior to continuing price to go, of course, inevitably lower. So the last thing, and the last and final thing for about another minute or two, let's just look at a collective examples of both buy and sell order blocks. If we're starting over here, when we see, just starting right here in the segment of price action, correct? We see a candle that ends up doing what? We have an immediate imbalance after this candle from here. Now, the reason I illustrated this, as mentioned, is because what needs to happen? Well, the imbalance between candles 1 and candle 3, notice how price comes into it. But does it ever completely come back to candle 1? The wick high of candle 1? No. So what needs to happen is we're actually just going to go ahead and direct our attention to refine the imbalance, just to illustrate that there's still imbalance before the order block. So at some point in the future, price must come back to the order block. Where's the liquidity? Well, clearly we can see that we have some form of liquidity here, right? General buyers who are in the marketplace, we're going to be looking to enter their position for buys over here. So this liquidity is already validating this order block, because as we collectively see all the support, what we know is support will end up getting manipulated. These stop losses are going to be effectively collected, right? Because institutions are causing the sell-off to happen to liquidate their stop losses. And that's where we're entering. So we're entering where all retail traders are getting stopped out. And of course, as mentioned in the bootcamp, it gets even deeper than that. But again, always ensuring that we're going to have a sniper entry. And then of course, what do we expect the price to do immediately thereafter? Well, this order block was mitigated. So now where becomes the next order block? We have our candle 1, 2, 3. There's no gap here, but however, there is a gap between here. So now this is the process of mitigation or order flow, where money has been transferred from here to now here. And this will be a future video. So if you're brand new or a little confused, do not worry. We're going to have the video here up in just a little bit. But now what do we expect in the future? Well, now this whole move, we have an imbalance. Anything that happens after this imbalance is unsupported. So what we're expecting in the future is price to come back down here, right? We have liquidity swept. We have an imbalance. We have an impulsive move, right? We have some form of structural break. So now what we're going to expect price to do, again, is build some form of liquidity, which we can clearly see that we have a general pool of equal lows or support. And after we see that, that's pretty much like, hey, like this is the right order block. little liquidated into it to then do what? Cause new structure to, right, continue much higher. But of course, all in between, you're going to see imbalances everywhere. Just directing attention to imbalances. 1, 2, 3, imbalance, right? So what is this? An order block. That price will come back to mitigate. But notice it's going to fail because why? Well, it's lying at liquidity, so it's not going to work. If your order block is lying at liquidity, everyone, if you don't get anything else from what I said, if your order block is lying at some type of liquidity, do not mark it out because it is a false or fake order block. But with that being said, everybody, let's go ahead and look at a couple more just directional order blocks. We have 1, right? What does it do? Sweeps liquidity. 2, we have the 1, 2, 3 candle formation. Again, this is not an order block, candle 1, 2, 3, because there's no gap, right? There's no gap. But candles 1, 2, 3, we do have a gap. So what effectively becomes the order block? This guy right here. And what does price do? It builds some type of liquidity beforehand, right? Builds some form of liquidity, aka an inducement we'll be learning more about as videos go on. And then what do? Liquidate the inducement into an order block. And then where do we target? We target new liquidity or new structure. And then what happens? This is establishing order flow. So now what happens is this order block was effectively mitigated, right? Now we had candle 1, candle 2, candle 3. There's no imbalance, but we do know, right, that this was an order block that was just immediately mitigated and price just kept going lower. So where becomes the next imbalance? Well, the next imbalance, right, becomes here. Candle 1, 2, 3. We have a slight imbalance, and this is still following that process of money transfer or order flow that we'll be diving into in the near future. So this is the area where the institutions must come back to break even on their position, right? We have some form of liquidity taken. We have an aggressive move to the downside. We have now an effective area of all resistance coming into play or equal highs before price gets liquidated and then reversing. And then, of course, at your own due diligence, you can pause the screen, go ahead and identify other order blocks you see because they're going to be everywhere. Imbalance, right? Order block. What do? We take out some form of liquidity. Liquidity, 1, 2, imbalance. 3, we do have a little bit of a momentous push. Following order flow comes to mitigate the order block, and then it drops. Over here even, right? We have one. We have this, liquidates. And now the order block itself doesn't take out liquidity, but the candle after does. And this is an extra refinement that I'd make a note of, is if this is your order block, just highlight the immediate wick to the left of it as well. And same thing. It gets mitigated. We have some form of high that's liquidated, and the price goes lower. All right, Dreams FX family, that was today's video, the first video to the topic mastery section, understanding order blocks. This was a very good video, and I hope you guys were able to enjoy, make some really good notes. And it's important to note that order blocks are fractal. You know, your higher time frame order blocks are going to be your points of interest, and your lower time frame order blocks are going to be your entries. So mastering order blocks is just the first step, and as illustrated in bootcamp, it's the first step in mastering the algorithm. With order blocks, they're all rule approach, but at the same time, they become very intuitive. As you start trading, the more you see them, the more experience, you're going to understand that only one of them is going to be the right one. Now, of course, you need to have that market IQ, the experience to really develop that intuition and understanding, which is going to be the right one. But again, it's a lifelong journey to education and becoming the 1%. Unfortunately, you're not going to master this overnight. But again, in becoming the 1%, we have to do what the 99% aren't doing. And besides the strategy, it's developing the mindset that's going to help us get there. In order to become the person, the trader, the best version of ourselves that we want to be, we're going to have to do things we've never done before. With that being said, everyone, join us in the next video. Have a great rest of the day, and see you all soon.